Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Dave Albrycht, President and Chief Information Officer at Newfleet Asset Management. Dave joins me to discuss the fixed income markets and where the sector opportunities are. Dave, it's great to see you as always. Welcome back to Trade Talks.
Thanks a lot for having me.
All right, you got it. Let's discuss risks and uncertainties in the domestic and global markets. Where's your focus?
Yeah, well, I'd call it risk and opportunities being a multi-sector manager. So if I had to, first and foremost, if I had to look at where I think the risks lie, I would say the magnitude of the timing of the economic slowdown. Obviously, I think we're under the belief right now we'll have a soft landing, really for three reasons. Consumers in good shape. If I look at corporations, especially leveraged finance corporations, they've extended and pushed out their debt maturity wall, which is good. And then we have another $1.7 billion of liquidity in the market due to private credit, which really helps out a lot of the middle tier companies, which would probably be a little struggling right now with default. So that's very, very good. If I look at some of the other uncertainties, the government shutdown, obviously looks like that will be extended out again. We'll watch that for volatility. Commercial real estate for the banks, probably not worried about the asset liability mismatch we saw with Silicon Valley Bank, but we now have a $117 billion maturity wall with commercial real estate coming due. So that's something we're going to watch very, very closely. If I look at the refunding risk, obviously the government is, with debt maturing, they're refunding that with a much higher coupon. So that's something we're watching closely. And then if I look at some of the global risk, first and foremost, I would throw out the Israel-Hamas war. What's going on there? Probably the biggest risk is spread and contagion. The Red Sea, I think, is a little underappreciated. It's probably 4 times more costly to ship and also 3 times longer to ship. And we'll watch that closely. Russia, Ukraine, got to be concerned there. Single biggest risk is the U.S. funding risk. Not getting much better. I think if we looked at it, they tried to weaponize energy last year, but they had a warm winter. They're 30% of the world's wheat. Most of that goes to the emerging economies. And if you look at a country like Egypt, where food prices are up 30 to 40%, that could cause social unrest. So we watch that closely. China, can't forget China. Obviously, weakness in GDP there. PMI is below 50. We have the liquidation of Evergrande in the real estate sector and shadow banking with bad loan creation. But they are providing stimulus. They just cut bank reserve requirements by 0.5%, which added another $140 billion of liquidity. Last but not least, we have half the world's population voting in federal and local elections this year in 2024. And that could cause some uncertainty. But all this uncertainty, to me as a multi-sector guy, provides opportunity and gives me an opportunity to invest in assets if they get cheap. So we're watching all this very, very closely.
And so what about your current view on inflation, the Fed and interest rates, and of course the yield curve?
Yeah, I would say, if we know what happened with the Fed, they've raised rates 11 times, 525 basis points. On hold, as we well know, data dependent, fighting inflation. March, obviously now we're down to about a 2% possibility of a rate increase. Our base case is that they start raising mid to late this year. So probably sometime July is when they'll begin raising rates. I'm sorry, cutting rates.
Cutting rates, yeah.
And cutting rates. I apologize for that. Cutting rates, and we're going to believe the Fed. I think the market hasn't believed the Fed for quite some time, but they said 3. They told us that, and now we're back to, I think, WRP is saying 3.3. If I look at some of the key indicators, growth in the fourth quarter was at 3.3%. Payrolls were strong. Oil is back to a very comfortable level. WTI and Brent at 78 and 82 respectively. Inflation behaving well. If you look at core PCE on an annualized basis, 3 and 6 months is around 2%. Unemployment at 3.7%. Rates are elevated from, just a few years back, and the curve after 22 months remains inverted, but we think it's going to hedge itself as the Fed starts cutting rates and begin to flatten. Good news and bad news about inflation. The good news is headline inflation is down from 10 to 3%. Supply chains have corrected, and really oil has come back to a more moderate level after the Russian invasion of Ukraine. Bad news, core services remain elevated and the labor market remains tight. So if I have to look at it, again, the Fed will cut rates 3 times. We're thinking that's going to happen later in the year. And there's value along the entire yield curve. You want to have short exposure if the Fed cuts rates 3 times, and then you want to have some duration, say intermediate duration, as long rates start to come down once the Fed begins cutting rates.
So Dave, with that backdrop, how are you thinking about and approaching the fixed income markets, and where are the fixed income sector opportunities?
Yeah, that's a good question. I would just say that, if I look at relative value in the fixed income market and I look at, where yields and spreads were and prices were back in the end of 2021, we were at premium prices, very, very low yields. Flash forward to today, we have dollar prices that are at nice discounts. That's when you want to buy fixed income. You have yields all-in yields that we haven't seen going back to the global financial crisis. And to throw out a few, if you look at, commercial mortgage-backed securities yielding 540. If you look at corporate bonds, yielding 530. If you look at high yield in the high sevens, you look at bank loans almost 10%. That's some great value, and value really that we haven't seen going all the way back to the global financial crisis. We like the entire curve, as I had mentioned before, both short and long, especially if the Fed begins to pivot and cuts rates. We're a dollar cost averager, so we have gradual moves, and you got to have powder dry, especially if there's some trade-off in the market. If I'm looking at sectors, I'd start with saying the high-quality securitized sectors make a lot of sense, especially the front end of the curve. Out of index asset-backed securities, we love. Subprime auto loans is probably a great example, where 75% of our exposure was upgraded in the last 12 months due to the fact that used cars are up about 46% in the last 3 years. Non-agency mortgage-backed securities, great value. You're getting high sixes for a AA, 3-year asset, and then selectively some of the new senior commercial mortgage-backed securities where the rating agencies don't want to fall into the hole they fell into during the global financial crisis. They're requiring more credit enhancement as deals come to market, so we like that. In leverage finance, high yield and bank loans, stick with double Bs, have an up in quality basis, and if there's any type of spread widening, be able to add. Investment grade, our primary focus there is triple Bs. Triple Bs get downgraded, they don't default. There's only been one default in the last 7 years. If you went back over 30 years, you had Enron, WorldCom, Adelphia. Those were all fraud. So we like it. Our bias is definitely financials over industrials. That's been the right call this year. They continue to tighten. During the Silicon Valley Bank debacle, we went out and bought Huntington, Fifth Third, Citizens. We bought a lot of the GSIB banks. Citigroup, Chase, Bank of America, to mention a few, and those have all outperformed. They've been a great investment. Two more, if I look at emerging markets, local currencies definitely is beginning to look attractive. Then last but not least, as a crossover buyer for munis, not that attractive on a ratio basis, but if I'm an individual and I can get investment grade taxable equivalent yields of 560 and I can get high yield at 930, it's definitely in my personal portfolio. So we like the muni market.
All right. And finally, Dave, anything you plan to do different in 2024 in the last minute here?
Yeah, I just say that, we're using the same approach that we've used over the last 3 decades. Obviously, find the best relative value, allocate accordingly. We were pretty defensive in 2023, but we had top decile performance in our multi-sector funds. And if the Fed begins to pivot, we'll begin to add risk, especially if things trade off. And if we are really our ultimate focus is sector selection top down, which is 2/3 of our attribution, and then issue selection bottom up, which is 1/3 of our attribution. So we'll continue to do the same thing that we've done year in and year out, and we've done very, very well.
All right, Dave, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill. Thanks for having me.